So previously, we discussed about Section 26. It's all about general professional partnership. Now we will discuss about Section 27. It's all about the corporation or the domestic corporation. If you remember your Section 22, the definition of a corporation, it includes partnership. I will reiterate this. Whenever you read corporation in the realm of taxation, you disabuse your mind about the business organization of the usual corporation. As defined in Section 22 here, it includes partnerships, no matter how created or organized, joint stock companies, joint accounts, association, or insurance companies. But it does not include the GPPs or the General Professional Partnerships because that's Section 26 and a joint venture or consortium formed for the purpose of undertaking construction projects or engaging in petroleum, coal, geothermal, and other energy operations pursuant to an operating consortium agreement under a service contract with the government. Okay, so that's the key word here. There's got to be a contract. If this is just a joint venture or consortium, obviously that would be taxable if there is no service contract with the government. So we continue with the provision, section 27. You have a flat rate here of 30%. Okay, that's an example of the global tax system. Section 27 imposes 30% on all companies or what do you call these entities that are considered by the tax code as a corporation. 30%. No matter how big it is or how small it is, your income tax rate is 30%. Okay? Now, this one, paragraph B, section 27, this is all about the non-profit proprietary educational institution and hospitals. They have this preferential tax rate at 10%. But if their income from unrelated business exceeds 50% of the total gross income, then they would be subjected to 30% tax rate. You remember the St. Luke's case, right? But that's about the hospitals. You remember there are only two kinds of the special taxpayers who which are given preferential tax rates in section 27. That's the non-profit proprietary educational institution and hospitals. We'll go to St. Luke's later at section 30. But whenever you read section 27B, you always cross-read that with section 34A, paragraph 2, on allowable deductions. Okay? You take note of that provision. Okay, let's go to that provision. Now, here's your section 34A2. Here, expenses allowable to private educational institutions. You take note of this provision class because a private educational institutions, as mentioned in under section 27B, if they have this expense which can be claimed as a capital expenditure, they may also deduct that outright within the calendar year or taxable year as a deductible expense. Here you go. May at its option elect either to deduct expenditures otherwise considered as capital outlays of depreciable assets incurred during the taxable year for the expansion of school facilities or to deduct allowance for depreciation thereof under subsection F. So the meaning of this is that, say for example, they bought like 100 units of computers, or well, for the expansion or school facilities, 100 units of computers valued at say 100,000. Okay. Now, ordinarily in the accounting parlance, that would be treated as a capital outlay or what we call a capital expenditure, the capex. You treat that as asset. But under this code, the private educational institution has the option to consider that as a deduction outright, or they may treat that as an asset and deduct the allowance for depreciation under Section F. Remember, we will discuss it later about the depreciation. But the idea here is only the private educational institutions are allowed to have this option, not the hospital. I repeat, only the private educational institutions are allowed to have this option. Okay, because of Section 34A2. Okay. And okay, you know this already. Water districts are now exempt along with the enumerated GOCCs under RA 126. That's paragraph C of section 27. But there is an interesting case here, PAGCOR. Okay, the PAGCOR versus BIR decided on December 10, 2014. I haven't encountered that this was given in the bar, but you remember that PAGCOR is still exempt from the 30% insofar as its gaming income is concerned, because there is this in its franchise that in lieu of all taxes, it will just pay 5% of its gross revenue. But the income from other related services like the canteen or the restaurants and everything, not the gaming ones, they are, or those income are subjected to the 30%. That's PAGCOR versus BIR, GR number 215427. So you remember, if there's a problem, a similar problem, especially, well, of course, the examiner will mention the word PAGCOR here, or maybe a similar government instrumentality or whatever. It will give the problem it will craft the problem in such a way that it has a franchise and what's the term there, the magic word, in lieu of all taxes, proviso. The franchise tax, you have to pay so much on gross income. The lessons in PAGCOR is that because there is a franchise tax of 5% in lieu of all taxes proviso, then the franchise, what is the franchise of PAGCOR? Gaming. So the gaming income is subject to the franchise tax of, as stated in its charter, the 5% gross revenue. The PAGCOR, although it is not listed anymore under Section 27C, it is still not subjected to 30% corporate income tax, okay, but the 5%. But for income that are not related to the gaming income, then it is subjected to 30%. I hope it is clear. Okay. You also have this intercorporate dividends. Right? The intercorporate dividends class, you remember that a domestic foreign or a domestic corporation issues a dividend to another corporation, except non-resident foreign corporation, then that is what? Not subject to tax. You remember the tax on individual, when an individual, that's section 24 paragraph B2, right? Okay, let's go there. Okay, so here is section 24 paragraph B2. Now, on cash and or property dividends for an individual, there is a final withholding tax of 10% if the individual receives a dividend from a domestic corporation. Okay, if you receive a dividend from a domestic corporation, that corporation will withhold 10% of that dividend. But it is not so with intercorporate dividends as provided in section 27 delta 4. Here you go. Intercorporate dividends received by a domestic corporation from another domestic corporation shall not be subject to tax. The idea here, class, is that maybe I asked Justice de Mampao on this during the MCLE seminar 2 years ago. I think the wisdom here is that to encourage investments on corporations. So it's kind of, as I said, it's kind of an unfair situation because if the domestic corporation issues dividend to, like, because there are lots of stockholders, right? So you have this individuals having stock holdings in, say, corporation A, and corporation B also has a stock holdings in corporation A. If corporation A issues dividends to both individuals and the stockholder corporation, the individuals would be subjected to 10% final withholding tax, whereas corporation B will get the full amount. So, di ba, unfair? Anyway, that's the law. So, just remember, dividends received by a domestic corporation from another domestic corporation shall not be subject to tax. However, if non-resident foreign corporations receive dividends from a domestic corporation, then it is taxed at 15% final withholding tax. We will go to that later on about the provisions of non-resident foreign corporation. So I repeat, the income tax rate for corporations, corporation means, as Section 22 provides, it includes partnership, no matter how rated, except general professional partnership. That's 30%. Flat rate. And, well, we'll discuss the MCIT later. This is a more important provision because I think the issue on St. Luke's was also asked, but there are questions or issues there that were not yet asked in the bar. We'll go to that at section 30. Just remember, which I emphasize here, you cross-read that with section 34A2. Only schools are allowed to treat as expense those which would otherwise be classified as capital outlays. Okay, and this one, the PAGCOR. PAGCOR is exempt from the 30% corporate tax, but it is not exempt actually because they will pay still a franchise tax of 5% only on their gaming income because of the in lieu of the other tax proviso. But for income from other related services, that's subjected to 30%. So you would visualize that PAGCOR in its financial statement, or when it reports its income, it returns its income tax, then there would be several rates there, the 30% and the 5% for the gaming income, 30% for other related activities. And intercorporate dividends, not subject to tax, except when a domestic corporation issues dividends to non-resident foreign corporation. The idea here, class, is that, of course, if this is a non-resident foreign corporation, then that money would be taken out from the country because it's non-resident. So you have to tax that outright. Because normally, this non-resident foreign corporation would invest the money somewhere else. So we get a share. That's 15% final withholding tax. We will discuss the minimum corporate income tax next and the other jurisprudence all about Section 27.